People see an auto insurance renewal and think one thing happened. They had an accident, or the company just got greedy. A lot of the time, it's neither. Your bill can rise because the insurance price changed and because the way you pay changed. By the end of this video, you'll be able to read your renewal like a receipt. You'll know what part is the base premium, what part is fees, and what moved. And you'll know 3 signals to watch before next renewal lands. Picture this. You open the renewal email and the number is ugly. Last term was about $160 a month. Now it's $230. Nothing about your life feels different, so it feels personal. The first thing to know is simple. Auto insurance is 2 prices stacked together. Price 1 is the policy. That's the risk price for you, your car, and your area. Price 2 is the payment plan. If you pay monthly, many insurers add installment charges. It behaves like a financing cost. It's not always huge, but it's real money, and it can make a stable premium feel like it jumped. Now let's make it concrete with one realistic example. Say your 6-month premium is $1,050. If you pay monthly, you might see a down payment plus 5 installments. Add $4 to $12 per installment, and it can be another $20 to $60 per term. So, what actually moves the premium? Most renewals are driven by 3 buckets. First is your personal risk signals, tickets, accidents, claims, and sometimes mileage changes. Even a claim where you weren't at fault can change the math. Second is the car and repair cost layer. Newer cars are expensive to repair. Parts, sensors, and labor costs rise. If repair severity rises, the insurer's expected payout rises. Third is your zip code layer. Insurers price by region because claims cluster. Theft, weather damage, and crash frequency vary. If your area gets worse, your premium can rise. Here's the part people miss. Your renewal is not a fresh start. It's a recalculation with updated inputs. If last term's premiums were based on older loss data, the update shows up now. That's why the timing feels random. It's lag. Back to the example. Your payment went from $160 to $230. Separate premium from the all-in bill. That split prevents most confusion. It also tells you where to dig. On most renewal documents, you can find a declarations page. It lists coverages and the premium. Then you'll see a section for fees and installments. If the premium rose, that's a risk price change. If the premium is similar, but the bill rose, that's often pay plan pricing or a billing change. Let's do a quick math check. Suppose your premium went from $900 to $1,050 for 6 months. That's $150 more per term, or about $25 per month. Now, suppose you switched from pay in full to monthly. If monthly billing adds $8 per installment and you have 5 installments, that's $40 per term. That's about $7 per month. If you're still missing the rest, look for 2 more things: coverage changes and discount changes. Coverage changes can be automatic. A common one is adding roadside or rental coverage. Another is a change in your deductibles. Discount changes are sneaky. A paperless discount disappears. A safe driver discount expires. A driving tracker discount ends after the initial period. Or a bundling discount breaks if another policy changed. Here's a quick way to find the lever. Compare 3 lines, term to term: the total premium, the discount list, and the fees section. If your document doesn't show discount amounts, log into the portal. Many insurers show a discounts tab or a rating summary. Now, a counterpoint. Sometimes the premium rises for a reason that really is you. A ticket posted, a claim closed and got reclassified, or your annual mileage estimate went up. That's real. But it's not the only story, and it's often not the biggest one. The practical framing is this: your renewal is the intersection of you, your car, and your neighborhood, plus the payment method you picked. That's also why shopping and switching isn't a magic fix. You might get a different model or different discounts, but the underlying cost pressure can still be there. So, what can you do with this without turning it into advice? Think in options and trade-offs. One option some people consider is changing how they pay. Paying in full can remove installment fees. The downside is cash flow strain. Another option is changing the risk you're asking the insurer to cover. That usually means adjusting deductibles. A higher deductible can lower premium, but it raises your out-of-pocket if something happens. A third option is checking add-ons you don't use. Rental and roadside can be useful. They can also be redundant. A fourth option is verifying discounts. Multi-policy, low mileage, anti-theft features. Some are automatic, some require proof, and some expire. This is information, not a recommendation. The point is to understand the levers so you're not guessing. Now let's return to our example and tighten the story. Your premium rose $150 per term. You also have $40 in installment charges. You lost a $60 paperless discount you forgot existed. That's $250 per term, or about $42 per month. It's still painful, but it's explainable. Here's a common mistake. People fixate on the monthly number alone. Monthly can hide term premium changes and payment plan charges. Instead, compare the 6-month premium first, then check fees, then check discounts. Now, the credit product proof point. Look at your billing schedule. If you pay monthly, you often have a down payment and then installments. If you miss one, you can get a late fee and a cancellation notice. So, the risk isn't just the price, it's the timing. An unexpected renewal jump can push someone onto a credit card. Then the monthly insurance bill becomes part of a debt cycle. That's why this matters for budgeting and for debt interest. Now, 3 signals you can watch before renewal hits, so it doesn't feel like an ambush. Signal 1 is your policy's term timeline. Auto insurance usually resets every 6 or 12 months. Put the renewal month on your calendar because the best time to learn what changed is before it locks. Where to look? Your declarations page or app, the policy effective dates. What direction matters? If you're within 30 to 45 days of renewal, that's when updated pricing and discount validations often show up. Typical timing. You'll usually see a renewal offer a few weeks before the new term starts. Signal 2 is your claims and driving record feed. Not just whether you had a claim, but whether anything posted or changed status. Where to look? The insurer's claims page and your motor vehicle record if you're pulling it for another purpose. What direction matters? A new ticket or a claim closing with a higher payout than expected can raise your next term more than you'd guess. Typical timing. The impact is often delayed until renewal because that's when the rating refresh happens. Signal 3 is discount drift and payment plan creep. Discounts expire quietly and billing choices change the all-in number. Where to look? Your discounts list in the portal and the billing schedule that shows installment fees or pay plan charges. What direction matters? Any discount that disappeared and any fee you didn't have last term. Typical timing. Discounts often revalidate at renewal and installment charges show up as soon as you switch payment methods. Now, end with a 2-minute checklist. Pull up your renewal and do this in order. First, find the 6-month or 12-month premium on the declarations page. Write down the old and new premium. Second, find the fees and installment charges. Separate them from the premium. Third, scan discounts. What's new, what's gone, what has an expiration note. Fourth, confirm your coverages and deductibles did not change by accident. Fifth, check the billing schedule and due dates, because timing is where late fees start. If you do those 5 steps, you stop reacting to the headline number. You'll know what moved, why it moved, and which lever you're actually looking at. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns. And leave a comment with the next topic you want covered, or the one part of today's video you want explained even simpler.